Welcome to our weekly show focusing on the key macro trends affecting FX and the broader markets. Today we're looking at whether the US equity market can continue its remarkable tech-fueled run, or whether it's now time to look at hard assets such as commodities. Last year, the major US indices made double-digit gains, with the Nasdaq 100 up 20% and the S&P 500 gaining about 16%. And this was despite the taper tantrum wobble back in April. This rally was largely fueled by the ongoing craze for tech stocks, and particularly AI. Now that tech stocks have had a great run, many investors are getting nervous and are worrying that the current market setup is similar to that of the dot-com bubble and crash of 1998 to 2003. In fact, Deutsche Bank reports that 57% of respondents in their Asset Manager Insight survey thought that a plunge in tech valuations was the biggest threat to the markets in 2026. Cautious investors have been trimming and hedging their positions, but as you'll already be aware, it's rare that a consensus view actually becomes reality. You see, if everyone is already positioned for a bearish outcome, then it becomes harder for that outcome to actually materialize. And furthermore, many of the comparisons with the dot-com era are not comparing apples with apples. And that's because the final throes of the dot-com boom were fueled by debt, which had been boosted by lower interest rates that were cut for a number of reasons, such as the emerging market crisis, the threat to financial stability caused by the implosion of a hedge fund, plus concerns that the transition into the year 2000 could suck liquidity out of the system. Back then, rates remained too low for too long, and markets parted like it was 1999, forcing rates to rise rapidly again. Today, however, the investment in AI has not been fueled by debt, but financed by cash. US corporate cash flow has been rising rapidly in recent years, and this trend has been dominated by big tech such as Apple, who've been deploying that cash as capex. Yes, markets are stretched today, and they are pushing the upper boundary of historical valuations, but sentiment is not at extremes. If anything, there is still the possibility of lower interest rates ahead, more liquidity, and the potential for a future debt-fueled blow-off top. But some investors are taking a cautious approach to tech by switching into one of the other sectors that performed really well in 2025, which is the commodity sector, and in particular, metals. Silver, gold, and copper are all close to all-time highs. In fact, the current economic setup is a great backdrop for the types of hard assets that can be a useful hedge against inflation, which is one of the main factors that could eventually derail the tech train. And now let's look at some of the questions we've been getting from our viewers.
Okay, so the first question is the one that everybody seems to be asking, which is, will events in Venezuela fuel more market volatility?
Well, the new year has certainly started with a geopolitical bang, but it's rarely worth trading geopolitics. In fact, markets have shown relative indifference to the headlines so far. But it is another reminder of the ongoing global scramble for resources. A clear beneficiary so far is the US energy sector, that is now expected to be given access to Venezuela's reserves. The US also has significant oil refinery infrastructure on the Gulf Coast that can handle the heavy crude oils that are found in that region. But this type of crude oil is also one of the hardest to extract, so this story will play out over years rather than months and weeks. And therefore these events are unlikely to create any meaningful market volatility.
So the next question is the increase of margin debt in US brokerage accounts a concern?
Well, margin debt represents money borrowed by investors from brokerage firms to purchase securities in the US equity market. It's a form of leverage, and it can amplify both gains and losses. And margin debt matters because investors worry that high margin debt is a sign of excessive optimism and also risk-taking in the market. If stock prices do drop, then investors may face margin calls, forcing them to sell shares, which can accelerate a market downturn or even trigger a crash. Margin debt, however, tends to rise and fall with the equity market. Whilst margin debt has been rising, the S&P 500 has been rising at a faster pace. So that margin debt as a percentage of market cap has actually fallen over the last few years. So whilst today's level of margin debt is high, it's not historically excessive.
And the final question is, will the British pound continue its rally against the US dollar?
The British pound, or sterling as it's also known, gained against the dollar through most of 2025 and was rallying in the last few weeks of the year. And this is despite a UK economy that continues to underwhelm. But this is less about the direction of the British pound and more about the direction of the dollar. The pound wasn't sound. It was the dollar that was weak. And this is a dynamic that's at play in most currency pairs. We can see that the pound and the euro have moved in lockstep for a few years now. And it will therefore be down to the relative dovishness of the various central banks. And currently, it's the US that seems to be making the most dovish noises. All eyes should therefore be on the 10-year support level in the dollar index around about 97. If this breaks, then both the pound and the euro should rally on the back of general weakness in the US dollar, regardless of their economic performance. Okay, that's it for this week, but before I close, please remember that none of this is investment advice. It's for education and engagement purposes to help you with your own research. When investing, understand your own risk tolerance, time horizon, and investment objectives, and then invest accordingly.